Here's a qualified individual, and keep this in mind because the next item I'm going to cover also deals with qualified individuals. Sorry, just getting over a bug. Lamentably, not the coronavirus. I got something else, and so still coughing a little bit. So it'll be a periodic interruption for that. So sorry. A little glass of water, and back we go. So who's a qualified individual? Meaning, if you're a qualified individual, you get this increased lending limit from your qualified retirement plan. You've been diagnosed with the COVID virus. Your spouse or dependent, as defined in Section 152, which is generally the same as a dependent on your return, they've been diagnosed. And here's the more open language, this third bullet point, or someone who experiences adverse financial consequences as a result of being quarantined, furloughed, laid off, having hours reduced, being unable to work due to child care, closing, reducing hours of a business owned or operated by the individual, or any other factors that the Secretary of the Treasury puts out. That number 3 is pretty flexible, meaning even if you or a dependent or a spouse don't get this disease, and frankly, I hope they don't, I don't wish it on any of you, this last one, where you've been financially adversely affected based on furloughs, reduction of hours, yada, yada, yada. If you're going to qualify, I'll bet you it's going to be under that third bullet point. So you want to give it a careful reading and see if you qualify. Now, being able to borrow more from your 401k is not the only retirement plan benefit that changed under this new CARES Act. You're also allowed to withdraw, and here we go to the next slide. You are allowed to withdraw from your IRA and your 401k. So this applies to each separately. You're allowed to withdraw from your IRA, and they add up all your IRAs as if they were just one account, right? They don't look at your IRAs as separate accounts. You can take out of your IRAs collectively or out of your 401k, potentially out of each 401k if you have more than one potentially. You're allowed to take out up to $100,000 as a distribution. Now, again, the plan document in the case of a 401k has to allow it. So some of the 401ks at your job may be more restrictive and not allow this. You don't need to amend the plan document for the IRAs. You can automatically do this with the IRAs. If you have a self-directed 401k, amending the plan document is pretty easy to do. You can take out 100 grand. What happens to that 100 grand? You've really got 2 options. First of all, the early withdrawal penalties, that 10% penalty for early withdrawal before the age of 59 and a half, that is waived. That's gone if you take out this 100 grand. You still pay tax typically. I'm not going to go into details, but 9 out of 10 times, if you withdraw this 100 grand from your retirement account, you're going to pay tax on that withdrawal. So you have 2 options. You either decide, I'm keeping that 100 grand out, I'm not going to put it back, and I'm going to pay tax on it, in which case you pay the tax ratably over 3 years. So they give you a certain amount of time to pay the tax on that withdrawal. Or you put the money back within 3 years, and that's a strict deadline. You miss it by a day, too bad. You put the money back within 3 years, then they treat it as if you never removed the money to begin with. And you can put the money back into the same account, or you can put it into any account that you could have rolled the original account over into. So let's say you have an IRA and you have a self-directed 401k, you pulled 100 grand out of the IRA traditional, and you chose to put it back instead of into the IRA, you put it into your self-directed 401k. Can you do that? Typically, yes. I have to know details to know for sure, but typically that is a valid rollover. So are you allowed to put the money into another account as long as it's an account you normally could have rolled over into? Yeah. So you have a choice. You either take the money up to 100 grand, pay tax but no early withdrawal penalty, and you pay the tax over 3 years, or you put the money back within 3 years and they treat it as if you never took the money out to begin with, making it functionally a loan. Now, we don't know how to deal with this on the tax return yet. The IRS hasn't yet caught up with, oh, and by the way, here's how we implement all this. Thankfully, I think they have 9 or 10 months to do it, and they should get on it fairly quickly. RMDs, let me translate into English. RMD is a required minimum distribution. Once you hit, depending on what your birth date is, 70 or 70 and a half, sorry, rewind. Once you hit 70 and a half or 72, depending on when you were born, you're required to distribute a certain amount from the retirement account every year. If you have an inherited retirement account, you're required to distribute. These are known as required minimum distributions, RMDs, the tax geeks, and basically you don't have those for 2020. If you already took RMDs, if it's still 60 days, in other words, you're still within 60 days of having taken the RMDs, you can just put the money back. Or you can decide, instead of counting it towards the RMD, to count it towards your $100,000 distribution that we covered in the last slide. You have an extended deadline to contribute to your IRA, to your health savings account, and to your Coverdale educational savings account. So you have an extended deadline to contribute to that. The normal deadline for 2019 contributions would be April 15th of 2020. That's been extended to July 15th of 2020. So basically, if you didn't make the April 15th deadline, you can still do this. Does not apply to any other retirement plan type contributions. So can I contribute to my 401k for 2019? No. Various deadlines have been extended. 1040s and 1120s for calendar year C corporations, but not fiscal year, were automatically extended from April 15th to July 15th. Paying late, if you normally, the penalties ratchet upwards if you didn't pay by April 15th, they've changed the ratchet date to July 15th. The extended deadlines have not changed. That's important to note. So your partnership and S Corp returns are still due if you extended them on September 15th. Your individual and calendar year corporate return are due on October 15th, assuming that you extended them or shall extend them, because you got a deadline extension for that. If you're in a 1031, you've got two important deadlines. You have 45 days to pick a property or properties to replace the one you sold, and you have 180 days to close. Well, if either of those deadlines, the 45-day or the 180-day deadline, fall on April 1 through July 14th, so if they fall anywhere in that range, April 1 to July 14th, it is now deemed to fall on July 15th. So you have a longer amount of time to select properties or to close on a deal if one of those deadlines fell during that interval. Here's one, this 1, 2, 3, 4, fifth point is a big one for me. I set up a lot of small private opportunity zone funds. Now, a lot of people think opportunity zone funds are only for the big people. No, you can, if you want to, set up a fairly small one and run it yourself. All an opportunity zone fund is an LLC that follows certain rules. In fact, I'm fairly certain Kathy has some opportunity zone funds that she allows people to invest in. The tax benefits of investing on these are insane. If you're into buy and hold, I got to give you two other qualifications for this to make crazy sense for you. If you're into buy, massively rehab or build, hold, and rent. So you're into buy and either massively rehab, and I'm not going to get into the details, we don't have that kind of time. You massively rehab or you do new build, and it's in an opportunity zone area, which are typically, down and out, lower economic areas, although we've seen a lot of gentrifying things in those areas. So some of them are not as rough as you might think. The bottom line, you acquire property in an opportunity zone fund. You can't just acquire the property. You have to buy it in the proper LLC from day one, or you blew it. We've had a lot of people do that. I bought an opportunity zone property. Where are my tax benefits? Oh, you blew them. You didn't. You were too cheap because you're a landlord, and that's what landlords do. To talk to good tax counsel ahead of time and understand that that property had to go into an opportunity zone fund. That's our special LLC from day one. So why do we love it? There are three benefits. A, you get to defer the capital gains for about 7 years till 2026. B, you get to forget about 10% of those capital gains. 10% of it will be forgiven after owning the LLC for 5 years. But the really good one, I call it the J-Lo benefit, this great, big, beautiful back end. Once the LLC, the fund, once the LLC turns 10, so it just turns 10, anything it sells gets sold tax-free with no depreciation recapture. Let me repeat that. Anything it sells after age 10 sells tax-free without depreciation recapture. Those are tremendous benefits. So they changed the deadline. You have a certain amount of time to invest capital gains into an opportunity zone fund. You have to have opportunity, you have to have capital gains to fund an opportunity zone fund. Otherwise, you can't have one. Well, they've extended the deadlines. So if your capital gains investment in the fund date fell in that range, April 1 through July 14th, it is now deemed to be a new deadline of July 15th. No other deadlines have changed, right? So I got the deadlines that changed here. S-corps didn't change, partnership deadlines didn't change, 401k contribution deadlines didn't change. Please stop emailing me and asking this. It's extremely annoying. I get a ton of emails. Hey, can I contribute to my 401k late? No, naughty, bad. Net operating losses. If you generate a net operating loss, now understand if you're getting losses from rental properties, that's a passive loss. Unless you're a real estate professional, there are certain other exceptions, but they're pretty rare anymore. If you're a real estate professional, the passive loss on your rental converts to a net operating loss. If you have net operating losses, normally prior to this law, you could only carry them forward into the future. Now you're allowed for 2018, 19, and 20. So for 18, 19, and 20, if any of those years has a net operating loss, you are allowed to carry it back 5 years. What's the benefit? Well, you get a refund, right? If I have a $200,000 net operating loss in 2018, I go back to 13 and my income was 50 grand. Now my income's zero and I have 150 of loss to carry over into the next year and so on. Well, that gets you refunds. Now you do have to have your accountant do some math. And here's your to-do item. Your to-do item is ask your accountant, A, do I have net operating losses? We call them NOLs in the tax world for 2018 and 2019. And then 2020, you don't know yet. Maybe you will, maybe you won't. Given how this year's gone for a lot of people, probably you're going to see some. But you ask them for 2018 and 2019, A, do I have an NOL? And B, am I better off carrying it back and getting a refund for the years that I carried back to? Or am I better off carrying it forward? And it has to do mostly with which years are higher bracket years. For example, if you look at your prior years and they're all low bracket, but now you're in the top federal bracket and think you will be for future years, it makes sense to carry the losses forward, not backward. So that's the kind of calculation you have to make. So your to-do items, ask the accountant, do I have NOLs for 18 and 19? And if so, B, please, Mr. Accountant, do some math. Should I carry them back or should I carry them forward? Because for those 3 years, you have the option. You are not forced to carry them forward. Qualified improvement property. All right, if you have commercial non-residential property, then you want to take a look. Here's your, let me give you the gist. Internal improvements, so not external, not patios and driveways and external things. Internal improvements to non-residential commercial property, such as stores and restaurants, used to be, under the old law, they were deducted very slowly on a 39-year schedule, which is about 1.5% per year. Now you're allowed to deduct it all in year one. So to give you an example, and this applies to 18 and 19 and going forward, so you may have to amend your 18 returns. Let's say you had a restaurant. In fact, I even have an example on the next slide of how this works. So John owns a restaurant with several dining rooms. He had a bar constructed in one of the rooms. It's internal. And by the way, internal improvements don't count if they're elevators or escalators. So he has the bar placed in service in 2018. He paid 200 grand. Under the old law, he was only allowed to deduct 1.177%. That was his depreciation, which was a very small number, $2,300. The new law says, congratulations, this is now bonus depreciable. This is now bonus depreciable, meaning you can depreciate the whole $200,000. So in his case, if he wants to generate big loss or show less income, he would go to 18 and amend his return. And instead of taking the 2,300 in depreciation, take the 200,000. So here are your to-do items. Have your accountant look at your return. Do you own any 39-year property? If so, did you do any improvements internally on the property in 18 or 19? If the answer is yes, would you like to depreciate it all at once, the total cost of it, or would you want to stick with the conservative, slow depreciation? And for most of you, the answer would be depreciate it all at once and get a much bigger write-off, but not for all of you. Sometimes there are circumstances where it doesn't make sense to accelerate the depreciation.